Practice. Hi, very good evening, everyone, and welcome to our first of a two-part special as we celebrate 20 years of S-REITs. Today's session is proudly organized by the Edge Singapore in partnership with SGX Group and REITs and sponsored by ESR Logos Funds Management and Land Lease Global Commercial Trust Management with our exclusive event broker, Tiger Brokers. So the title of our topic today is E-commerce, Opportunities and Challenges for S-REITs. So before we start, let's watch a short video that celebrates the 20th anniversary of Singapore REITs produced by REITs.
Singapore is Asia's fastest growing REIT hub with a 20-year track record and an annual growth rate of over 13% over the last 10 years.
S-REIT today offer a diverse profile of global sponsors
with a total market capitalization of nearly $100 billion.
S-REITs dominate Singapore's IPOs and secondary offerings in terms of the amount of proceeds raised.
That offer long-term sustainable total returns and one of the highest dividend yields with lower volatility.
S-REIT are anchored by the Singapore brand name, which has always been synonymous with political stability.
High levels of pragmatic governance.
and efficient tax regime.
We have a conducive regulatory environment that was developed in close consultation with the industry.
There's also been great diversity in the assets being listed.
And vibrant secondary capital markets.
We have a very strong international and Asian institutional base that support the REIT product here.
The S-REIT industry was conceived because of the determined and unified efforts from multiple stakeholders.
We started in 2002 with just purely Singapore assets.
Singapore was coming into its own at the time as an international financial hub.
We had a vision to grow the REIT ecosystem in Singapore and establish ourselves as a global REIT hub.
Singapore quickly became an Asian REIT hub when Asian sponsors saw the viability and success of the initial S-REIT listings.
From 2007 to 2013, we saw a huge increment in Asia assets being listed as S-REITs. This trend has only continued to rise.
The founding of REITs in 2013 was to strengthen Singapore as a fundraising center for REITs and to enhance Singapore's attractiveness as a listing center for foreign REITs.
From Asian sponsors with their overseas assets, we are also now seeing the inclusion of sponsors from different global jurisdictions coming to Singapore to list their REITs right here.
The fact that most S-REITs hold a substantial number of foreign assets.
It's a clear validation of Singapore's transformation into an international hub for REIT listing.
This is a signal to Singapore that its governance and investment structures have a place on the world stage.
Singapore has now become a meaningful weight in the global real estate benchmark.
As the sector explores opportunity to further enhance its scale and competitiveness, mergers among S-REIT have been gaining traction in recent years.
Mergers provide S-REITs with more growth optionality.
Higher levels of gross revenue, net property income, and DPU.
Investors here will have an exciting time where they can invest into new asset classes, into the best-in-class sponsors, delivering them the best performance returns.
Sustainability plays an integral part in the future of S-REITs.
There will be increased demand for green buildings that integrate property technology.
As investors seek to invest in ESG-friendly real estate,
providing stable and growing distributions over the long term.
The future for the Singapore REIT hub is bright and it is exciting.
There is an extraordinary investing power in Southeast Asia, which directly impacts Singapore as a global REIT hub. We see this developing considerably over both short-term and long-term future.
the sector will continue to further internationalize and develop in size and diversity.
The S-REIT track record over the past 20 years gives us the confidence that the next 20 years will see this innovation be embraced and implemented.
Well, that was a very nice video summing up the 20 years of S-REITs and for the future of S-REITs. So now let's put our hands together to welcome Nupur Joshi, the CEO of REIT Association of Singapore, to give a few words.
Thank you, everyone. Good evening, and thank you for being here today, this evening. I know many of you are watching from home, so thank you to the virtual audience as well. So I'm delighted to deliver this welcome address today, and I would like to particularly thank Gula and the team at The Edge for organizing this series of events and coming out with their special supplement to celebrate 20 years of Singapore REITs. I was going to say a few words of Rita's, but I think you watched the whole video which we produced, so I will skip over that part. Suffice to say, we are the industry association that represents Singapore-listed REITs. We liaise with regulators on common issues impacting REITs. We run training programs and train around 500 REIT professionals annually. And we also organize investor engagement sessions for 3,000 people every year. So coming to today's theme, the theme of today's session, as you know, is e-commerce, opportunities and challenges for S-REITs. E-commerce has been gaining traction for several years now, and the pandemic also played its part in shifting consumer behavior towards online channels. In the early days, there was a fear that online shopping would displace retail malls in Singapore, just as they did to department stores and malls in the US. This did not happen. What did happen was that mall owners had to reimagine how their space would be used by customers, and this required a higher degree of innovation and creative thinking than in the past. On the other hand, e-commerce has, for the most part, been a positive for the industrial and logistics sector. It has changed the way logistics is handled. These include increased focus on digitization, last mile delivery, and changing customer expectations. It is said that change is the only constant. Another constant, in my view, is the value of good leadership to steer a company through challenging times and emerge stronger. In this regard, I'm delighted that there are two respected REIT CEOs in this session who can break down for us their perspective on e-commerce and how they are dealing with the challenges and opportunities it presents. Along with Jeff, it's a fantastic lineup, and I look forward to hearing their take on today's important topic. Thank you all. Over to you, Gula.
Thank you, Nicole. Okay, so now let's invite our moderator, Gula Warden. She is the executive editor of The Edge Singapore for today. And our panel of esteemed speakers consists of Adrian Trey. He is the CEO and Executive Director of ESR Logos Funds Management Limited and manager of ESR Logos REIT. Next up, we have Kelvin Chow. He's the CEO of Land Lease Global Commercial Trust Management. And last but not least, we have Jeff Howie. He is the Market Strategist of SGX Group.
Thank you everybody for being here, and Nupur, thanks for your kind words. And
sorry, before we start, I would like to say that we have the QR code for the pigeonhole, so you can post up your questions. So scan the QR code and enter the passcode S-REITs22, and you can post up the questions, and Gula will try to address them during the panel discussion. Okay, over to you, Gula.
Right. Okay. So
thank you.
Well, thank you, Nupur, for your kind words, and thank you, the panel, for being here. So we have Adrian on my left, and he's the CEO of eLog's, the ESR Logos REIT's manager. And eLog, which was formerly ESR REIT, has grown to an AUM of 5.5 billion from around 3 billion.
1.5.
Yeah. Yes. So following its merger with the former RR Logos Logistics Trust. So we can ask him all the different questions about M&A. And then on my far right, we have Kelvin Chow, formerly he was at Capital REIT.
Yes.
So any questions on commercial, he can answer too. Yes, and he's the CEO of Land Lease Global Commercial REITs Manager. So L-REIT has actually doubled its AUM within a few,
within 2.5 years.
2.5 years. with the acquisition of GEM, and we all have been to GEM, so it's now 2.6 billion. And it comprises, I think, more than 75 to 76% of gross rental income from retail.
Yes, that's right.
So, e-commerce, what an opportunity for the REITs.
Yes.
Kevin, over to you.
It's always a tricky question because e-commerce seems to be directly hitting the retail sectors. But I would think that it's not mutually exclusive. I think what we know is really, or rather what the tenants do together with us is really to work out a right marketing strategies to how to actually overcome it. And I think that it will actually help them to improve even their positionings and also how they actually strengthen their brand image and everything. So e-commerce, while actually is easily accessible, I think there's also it also actually create the kind of cold kind of interaction with the customers and all those things. So I think with a physical kind of shops, you can actually have a stronger kind of interactions and also build up the kind of customer relationship. I think I always actually like to quote an example when I think some of the e-commerce players eventually or rather start to actually set up physical store in the malls. I think for example of the Love Bonito, they are doing quite well on the online, but they decided to set up their first flagship in 313 at Somerset. I think this gives evidence that actually they want to strengthen their relationship and also strengthen the way they actually dealt with customers, and of course e-commerce do actually have their shortcomings. I think as the mall operators, what we actually do is that we also help some of the smaller or some smaller size kind of tenants that actually they don't have the platform to help them to establish a platform so that they can actually use that to market their products and also to a certain extent do promotions and also extend some kind of marketing strategies to that. So what we do is that we do actually have a loyalty apps which actually called Landis Plus, which actually we use to accumulate a lot of members in the apps. At the same time, provide a kind of marketing platforms for some of these tenants that actually want to use this as a platform for them to market their products. I think that's the way that we sort of help them to sort of promote. At the same time, we do actually have some cross collaborations, and also we're using some social medias to sort of reach out to different kind of customers that actually relate to our tenants, so that in that case to build up that kind of connectivities and also to help them to strengthen their sales. And we are happy to share that. I mean, as of now, I think our sales number for the malls is already exceeding our sales number pre-COVID by easily double digit. So in that case, I think it seems that our strategy works for them.
Jeff's from Queensland, and you've been back recently.
Yeah.
How is e-commerce like in Australia? Have all the shops closed down, the department stores?
Actually, I'm not. I would say it's similar to Singapore in that you have obviously the traditional shopping centres, and of course you have the omni channels and the direct, basically ordering online. The one thing that's interesting though is the composition of the shopping centres. They, basically, if you put e-commerce into the equation, then potentially you have less tenants with retail facing, third party type of companies in there, and you have sort of like more, like we see here, more educational centres, like the commercial and the office REITs. You see more of the technology type of tenants at a retail level, as well as healthcare, of course. So that transposes over, but you don't see a lot of the really exciting e-commerce growth, I think, in my home country that you see in Southeast Asia. You had 70 million people use e-commerce digital platforms for the first time ever in 2020. For Asia Pacific, which does include Australia, you've got the e-commerce economy expected to grow to $2.8 trillion by 2025. That would represent 65% growth thereabouts from 2020. So you've got this really super exciting momentum here, Gula, that I guess I was, spending too much time with the family, having barbecues and so forth. I didn't really.
Yeah, in fact, I mean, if you look at the statistics, I think during the pre-COVID, we was looking at around 7-8% of people using e-commerce on the overall of the sales number. It shifted to around 20% when during the COVID, and then actually moving back to 15. So you can see that while people are using e-commerce platform as a way to actually purchase, I think at the end of the day, I think physical store is still relevant as long as you keep changing your products and offerings to the mall. I think that's where you actually have to continue to stay relevant. I think that's most important. You cannot be same old, and then of course you will not be able to attract the right customers to the mall, and then you will not be able to help the tenants. I think the thing is that for mall, it's really a tripartite kind of relationship. You have to help the tenants in order to reach out to the customers, and what you do will affect their ultimate sales. So I think that's what you need to actually constantly communicate with the tenants to help them to push up sales, and also help them to put on the right marketing strategies in order to to grow their sales.
Okay, so these guys are friends, but e-commerce has been I'm not at all, because you've actually increased your logistics assets. It's now more than 60%, is it?
Yes, definitely. I think e-commerce is a big factor in this, and I like to tell people and Kelvin is probably one of the most expert in retail, and is that, you know, if e-commerce is what I like to call the frontline soldiers, because they are the one that's interacting with the clients. The logistics guys, we are the backbone of the whole business. Because without us, you don't get the final product, whether it's e-commerce or at a shop. Yeah. So yes, we have been a beneficiary of the e-commerce boom. But at the same time, it's not just e-commerce on the what we call FMCG, or fast-moving consumer goods, about clothes, fashion, accessories. It has evolved. It has now evolved into food, delivery of food, cold chain logistics. And in fact, as the e-commerce broadens to different kind of segments, not just fashion and accessories, into food, the logistics specifications of a building becomes actually more important. Speed, getting it timely delivered, getting timely packed is important. So the kind of assets that we ourselves now looking at logistics has also changed. The days where you can do for example, we have warehouses right now that what we call ramp-up warehouses, whereby the 40-footer truck can go up, unload, load, go off and deliver to the end customer or the retail stores. And we have cold chain, and each of the floors also have the 40-foot trailer whereby you can just dock it, and it's seamless. There's no change in temperature should we go into the cold storage facilities. Compared to 10 years ago, where warehouses were what we call cargo lift warehouses. If you are the guy that is on the 4th floor, somebody who's loading the goods on the 2nd floor decided to put his slippers in between the cargo lift. We got to wait another 20 minutes for that. But nowadays, no, we have that. So we have been we have been beneficiary of the e-commerce, in particularly during the COVID period. I'll be honest on that. But at the same time, we have also now seen that the logistics sector is not just on the e-commerce side. We have started to see a shift as economies start to open. Supply chain is still in a bad shape, disruption, geopolitical. You all guys know the geopolitical situations that's going around the world. We've now seen the manufacturers actually taking more attention into their logistics, that means the production. I like to tell people that the COVID, the last 2 years, has resulted in a big secular change in the way we produce our goods, we consume our goods, and we deliver our goods. So what we are seeing right now is that apart from e-commerce, the production side has resulted in a lot of manufacturers right now holding stocks and putting more important emphasis on logistics supply, their own logistics supply chain, from the production and warehousing of raw materials to even holding the final product. And this is what we are seeing. It used to be pre-pandemic, manufacturers do what they call JIT, just-in-time manufacturing. Today, everybody is practicing, not everybody, most people are still towards JIC manufacturing, just in case. So they are all holding raw materials as well as finished products. So we have been a beneficiary of it. I would say that e-commerce has started it in pre-COVID, especially in 2015, 2016, 2017. But COVID situation has now shifted the demand for logistics assets into not just the e-commerce part, which people tend to think is the final delivery of the product, but has also resulted in manufacturing process of the production part as well.
So things like farmers and pharmaceuticals and ships, they need temperature control. That's
So we've also been seeing pharmaceutical logistics. Now this is another level. And so because of that, we're also starting to see our tenants undertaking digitalization of their own operations, logistics operations. It used to be, I would say many years ago, when the trailer leaves the airport to go to the warehouse in Tuas, the best technology is to pick up your handphone, dial number and say, I'm coming in 10 minutes time. Now it's live tracking. The traders have actually been able to track. And if you think that the Japanese Shinkansen timing is good, trust me, some of these logistics trailers, they are really good. And they can even reroute for you the routes. So that's what we've been seeing. Technology and digitalization has changed even the logistics operations overall. And I would say, yes, I would agree with you and even Nepo at the start that, we have been a beneficiary of that tailwind. And we think that tailwind will likely continue.
So, Kelvin, has this revenge shopping that we're seeing, which is what we're seeing everybody heading towards the malls, is this temporary, or do you think we will all go back to our retailers and order online?
I think two ways to look at it. Of course, people thought that it's a temporary things, but I'm looking at the trends that we have on the sales number. It seems to be able to continue. It's quite consistent. And I will actually look at how actually you do the trade mix and how you actually continue. I always emphasize the words relevance. The thing is that if you are not able to stay relevant, no matter what you do, and you cannot attract, you cannot reach that kind of returns that you're talking about. So for us is that we always keep ourselves nimble to see what are the things and what are the trade that actually can attract our target shoppers. I think our target shopper is the young professionals that like to come and they like to have something fresh, but at the same time they come to Orchard Road, they don't actually want to do one thing, but they want to do several things. So you produce everything in the mall, I think that's relevant to them. I think that is a plus. The other thing is that, as I have emphasized, we do actually wanted to change now the profile of our tenants. So the profile of the tenant means it's not that only on the sales and product they are talking about. We're also talking about their marketing strategies. We look at tenants with omni-channel kind of strategies, which they have multiple ways to distribute their products and also touch on different areas of the customers. Some people would want to do online shops and then they get it delivered, but they have to wait for a few days. Some people to actually go to the shop itself and they buy and they can then immediately return it. And it's straightforward, they return you the cash. If it's not, you purchase it online, it will take a while for you to get back the money. So I think that's when we start looking at there's several when you look at the tenants, you look at, of course, the first layer is what is the service and products that you're going to put in the mall. The second layer is that what is the marketing strategy they are going to actually impose. They are going to put in omni-channel, or if you need to actually help them extend, how are they going to extend them to reach out so that in that case their sales continue. You need their business to be viable before you can actually sustain your sales number in the mall. I think the third things I will look at is how we continue to attract people like those online seller like the Love Monitor kind of things to go offline, because our location is very strategic. We are actually in the middle of Orchard Road, above Somerset and Somerset MRT, and that is why people like Love Monitor decided to actually set up their first offline kind of shop here, and they actually do it very well, and they actually establish around. And Love Monitor is just one of the several examples. So we actually can continue to go on these targets tenants to actually still help these online to offline kind of tenants to grow their businesses, which I think there's also another layer of strategies. We capitalize our strategic positions being in the middle of Orchard Road and continue to target on our tenants and target on our target customers to sort of grow the tenant business. I think that's what we intend to do.
So on the operations side, so rising interest rates now, that affects everybody. Everything we do is affected by interest rates. So how has this interest rate cycle affected some e-commerce players? Because we read in the press that some of them are shedding jobs. So how would this affect online shopping and your strategy? So well, I'll ask you about rising. He's got plenty of time to talk about rising online.
I think the rising interest rate, unless people like Adrian's, I mean, want to pass on the cost on deliveries and also the warehousing cost to the online platform, then I think that will probably make people consider whether what is the value proposition for them to actually do online compared to what they do offline. So I think the rising interest costs in the Singapore context actually I think it's more relevant to the operators, but it's not. It's really a cost concern between how. I mean, I used to actually purchase, although I operate more, but I used to purchase something from maybe the Lazada and all those things. It used to be free delivery, but now they actually start charging you. So I think you can see that the cost complements and also the value propositions has changed. And is it wiser for you to actually go down to the mall and buy it that you have to spend such a cost? I mean, depends how you look at it. Of course, that is not a big sum, but I mean, eventually, that is something that you need to consider because beside the conveniency that you deliver to your house, I think you also have to also see at the delivery cost because sometimes you might see the same products in probably like the platform like Lazada and all those things, but when it comes to you, you doubt whether it's a real thing or bad. I mean, it's not a real thing, right? So in that case, perhaps taking the cost into consideration, you might just want to go to a shop and buy it. I think that's the thing I would think. Other than that, I think there's no direct impact to.
So now Aidan's going to tell us about the impact of rising interest rates on everything else.
Yeah, I think it's inevitable. We had close to a decade of low interest rates. And then we have the global pandemic that essentially, I would say, jumble up everything. You can then have two giants, US and China, having a quarrel. And with the pent-up demand that's going on in the last 2 years, now everybody, as you said, revenge shopping. Everything is now revenge. Revenge eating, revenge shopping, everything is revenge, right? It's inevitable. Demand actually goes up. And because supply chain is disrupted, you have demand that's here, you have supply that's here. Ports are not opening. People, after 2 years, even workers are not coming back. You know, you lose half the people when the causeway opens. So it's inevitable that inflation will come in. And the only way to manage inflation is obviously rising interest rates. So it's inevitable. But I believe that we will find an equilibrium. Every economy in every cycle, that's why there are cycles. You will find an equilibrium. I shared with you about e-commerce that we mentioned just now. We were the beneficiary of e-commerce during 2020 and 2021. But I can also share with you that we're going to see soon the demand for logistics facilities from e-commerce coming down. It has to be because in 2020, everybody was staying at home. 50% of people are staying at home. You know, you have to order your stuff online. So naturally, the demand actually goes up. Like, whereas now you see some e-commerce company, so everybody expanded, hired a lot of people. Even Grab, suddenly you have a lot of but now I understand that Grab is seeing the number of driver pools has come down because the people has come back to work. Now you can go out and you can buy your meals, and you can go to his mall to have at the food court and eat.
I give voucher to you.
Yeah, voucher.
Sign up as a land lease member, you will have $5 voucher.
So where I'm coming from is that you will have to reach an equilibrium. All right. That's why you see the likes of the Shopee or whoever others looking at closing down stores, closing down number of staff. So we are going to see the demand from e-commerce coming down, but for at the same time, we are seeing it being replaced by the manufacturing demand that I've just described to you. Now, supply is still not there because it's catching up, but it's slowly catching up because there is still disruption. Our friends up north is waiting for the biggest event in October to elect someone to be the third term when the whole damn bloody world knows that 2 years ago he will be the president. I don't understand why they want to hold it in October. It's still opening up. So it's going to be still be the case. So and in terms of how interest rate environment affects us as a REIT, it's always interest costs. And I think I must say that by default itself, Singapore REITs, and thanks to MES and REITs in particular as well, from ensuring that the gearing level of a REIT is always kept low. So in a way, you don't have a full impact of a rise in interest rates. And on top of that, most REITs are pretty prudent in the way we hedge our interest rates. Most people, it's more than 50%. Average, I think, is about 60 to 70%. Yeah, 75%. And that is why with the low gearing, regulatory low gearing, and also with the hedges that the various REITs put in place, I don't think it will be that impactful. My frank opinion is rising interest rates, yes, it does eat into your DPU, but at least there is a little bit of, you can still survive. You can still, as managers, we can, it's not that scary.
You can pass on costs. Can you pass on any of the costs?
You can, but there's just so much that you can. And for me in my sector, because the rising interest rates in a way is less mitigated by the fact that there is a demand on the rental side, the positive rental reversion. So it's sort of like managed. My frank opinion is a more scary part is when there's no liquidity in the market, because nobody's willing to lend you money. That is worse. Rising interest rate, I think is manageable. Gearing, natural SGX gearing and hedges, most managers like us were pretty prudent with how much fixed rates that we have, as well as the tenure. But when it comes to liquidity crunch, we've seen during the GFC 2008, 2009, that is actually more dangerous.
But you guys have got committed revolving facilities.
Oh, we have.
Facilities.
Most of us we have because
you've got it too. Yeah. So these two are quite safe. What are your investors concerned about, both of you? When I come to you shortly, how it affects SGX, but yeah.
Maybe I go first on this. First half of the year, the two biggest elephant in the room for concern is utilities costs and interest rate. I think utilities costs still continues to be the elephant in the room. For us, we have sort of managed it. We are able to pass through our, from July onwards, we are passing through 95% of our utilities costs to our tenants. It's like they pay as they use. We don't make, we are not Gencos. We don't know how to hedge or buy energy contracts. We just are landlords providing warehouse space and industrial manufacturing space. So we leave that utilities to the tenant for them to use. So we are not that afraid. Then in terms of inflation, yes, inflation affects costs in terms of maintenance costs, cleaning costs. We have gradually raised our service charges to sort of offset that amount. So that was the two elephant in the room in the start of the year. I think Kelvin will agree with me that now the concern that people are telling us is the R word, not revenge, recession.
Yeah, that's even worse than revenge.
It's actually a recession. So people are concerned about the interest rates, huge interest rate that's being pushed up will result in costs going up and then demand coming down, and then have we over-raised the interest rates such that the dread word recession will come in. So that's what the concerns that the investors has been telling us, asking us, and how we act, how we sort of manage that and monitor that. Yeah.
What about your? I mean, demand will affect your portfolio more than his portfolio, will it?
Yeah, I think. Okay, what happens is that of course more will be very sensitive to how the market change and all those things, and certainly for interest rate and also for utility is something that is major concern to our investors. But I think let's go back to the interest rate. I mean, the thing is that at this moment, the interest rate rise because FOMC was looking at the statistics of the employment actually has been better than expected, and then they actually want to raise it. But the thing is that what is missed out on the equation is really the China components. Actually, I would think probably if let's say China will be opened up and everything will be back to normal, we will have a very strong engine of productions again from China and all those things. Probably in that case, the employment will not be as favorable, and probably the cost of inflation will not be actually so high in US. So I think something is missing out in the equations, and then we are still waiting for things to change. So I think that while interest rate is a concern, but it should actually also take it as a very prudent kind of measures, not to over hedge yourself. I mean, to a certain extent, if you over hedge, that means you take a positions that actually if it reverse, then you'll be at a loss position. I think that's what we are doing. So we consciously mindful of what we are doing and create, as I said, always be nimble and create the flexibilities. I think this is the key word when you manage the interest rate. I think the other thing is utility cost. I think utility cost is a very tricky one. Again, it started off when the wars come, and then someone closed the tap, and then there probably some limitation of demand, and then the oil price went up, and all those things caused the utility cost to go up. Well, I mean, again, is it a temporary concern or a permanent concern? I think that's something that you again have to look at it. So don't position yourself. For us, I think fortunately we do actually have 1 year kind of forward contracts to sort of hedge our utility costs in advance, so that in the case we sort of enjoying a very good discounts comparatively. And the other thing is that, I mean, fortunately that we actually embark into this net carbon zero initiative. Net carbon zero, people would always think that, are you actually incurring more costs to actually achieve that kind of ESG requirement and all those things? The thing is that if you seriously look at it, you actually supposed to reduce your energy consumption, supposed to make yourself more efficient in terms of operating, in order to then actually in order to improve on your position to be net carbon zero. That is the key things before you actually go into other kind of means to actually reach your net carbon zero things. So what we do is that we do it earlier. So when it comes to the utility cost being going higher and all those things, our utility cost is actually, I mean, roughly around 8 to 10% of our overall cost. But I think compared to our peers, probably it's around 15. I think that's some of the things that we do that actually sort of like put us into an advantage position when it comes to this sort of sudden unexpected kind of changes in the utility costs and all those things. But I think at the end of the day, be it utility costs, be it interest costs, I think most importantly is to manage your top line. As long as your top line is able to perform, cost saving is one of the key things also. Of course, I think you'll be okay. I think your distribution will be stabilized.
Thanks. Yeah, interest rates. We've not had any, I mean, this affects cost of capital, et cetera, et cetera. So we've not had any major REIT IPOs this year. So is that being affected by the interest rate rises, or?
Oh, there's a number of things, Gula. I mean, there's two key geopolitical risks at the moment that are creating that overhang. The first is in Europe. The second is regional. You also have COVID-19 as an ongoing risk, albeit we're making some great developments over the past couple of weeks. And then number 4 is the interest rate risk, of course, greater than expected. The interest rate expectations have become increasingly hawkish over the year. In fact, they are currently at the most hawkish that they've been all year at the moment. So we have 3 more FOMC meetings this year. The first is very early Thursday morning. Then we're back on again on the 2nd of November, and then the 14th of December. And at the moment, markets are pricing in 200 basis points of hikes at over those 3 meetings. That would take the band in the US to 425 basis points to 450 basis points. Now, that is as hawkish as interest rates are expected to be in the forward years. So the thing is, the current market environment is highly fluid. It's very fluid, so that it creates a very vibrant type of leaderboard for the unit prices of all the REITs at the moment, because there's just so many factors driving this. For instance, Adrian said there's two elephants. There might be an invisible elephant there in the middle as well, because you've got the higher utility prices, the higher energy prices, and then you've got the Fed chair's greatest fear that those higher energy prices actually morphed into systemic inflation, where those expectations of higher inflation because of the energy prices actually do create the broader inflation. And that's what we saw with the CPI, a hint of that with the CPI number last week, which basically drove us to this most hawkish level at the moment. So these are high frequency numbers, highly fluid circumstances that I think do create trading opportunities for investors in the REIT market. And of course, you've got very different performances across the various subsegments of the REITs. Logistics, industrial REITs have been the best performing asset class across the world for the last 10 years, according to Cushman & Wakefield. This year, if you look at the REIT market globally, the FTSE EPRA REIT is down, of course. Global REITs are down, but our hospitality REITs, those four staple trusts, CDL Hospitality Trust, Frasers, Far East, as well as Ascot, and you throw Suntec in there as well, they've actually averaged 12% total returns. That's all been on the reopening momentum Adrian's been discussing. So you have elements of vibrancy according to the economic momentum that is really uneven, but you also have this broad overhang of those interest rates. And I think investors are kind of concerned on if the REIT does have to refinance next year or within the next 3-6 months, what impact would that have on the distribution yield? The 40 or so REITs that are listed at SGX, they maintain a yield at the moment around 6.5%. That's still 200 to 300 basis points above the 10-year MAS government bond.
The 10-year government MAS government bonds yields is at 3.2%.
Yeah.
Yeah. So you've got to work out. So everybody here has to work out, do their own sums, because usually the yield spreads around 3.9 to 4%. So you've got to do your own sums as to, what the yields are likely to be at or should be at. Okay. There's some questions from the floor, but before that, I want to talk about two topics: was the lease structures and the role of the sponsor. So the lease structures, I think we spoke about this earlier today. Lease structures. Has there been, but I'm going to, sorry, Kevin. Shopping mall landlords, has there been any change in your lease structures, such as higher levels of GTO versus the base rent, versus say from 10 years ago? Because that there's a REIT listed here from China that has, its lease structures just all GTO, isn't it? It calls it EMA or some structure.
I think to answer you directly, we don't see there's major change to the lease structure. I think for us, we still actually continue to actually charge a high percentage of fixed component compared to variable, and the fixed component is usually around probably more than 95% of our whole revenue structures. And beside that, I think something that interestingly, what we do is that we build in a rental escalation on a year-on-year basis, and the average is about 3%. So in that case, basically, that means without doing anything, our top line will increase by around 3%. I think also because of our net carbon zero initiative and all those things, we also want to make our tenants green. So what we do is that we provide them with a green lease, so that in that case, they will actually take on the initiative. I mean, it's not compulsory, but I think we will align to them on some of the things we do to actually save energy and all those things. I think that will probably bring down the overall consumption of the electricity. That's what we do through the green lease, which is, I think, quite unique in Singapore. And I think that's the structure for the mall, basically. I think for those that actually know us also, that we do actually own some office building. I think those office buildings have a long wheels, I think, and they pay a fixed rent on a yearly escalation. For example, three of our Milan properties that we have are actually on a CPI index peg. That's when we peg to CPI index growth on an annual basis. Then we will increase our rental based on that basis. And of course, once you increase, that will be the floor. They will not go down anymore. So it will keep increasing based on the CPI index. And the beauty of it is this is a triple net lease. So in that case, we enjoy while the inflation go up because CPI index go up.
we will not be suffered by the cost of higher. We will not be suffered by higher costs due to the inflation, due to the inflation and CPI. I think that's the beauty of our lease structure. So we are very much our cash flow is very much protected based on how we structure the lease itself.
Okay, so Adrian, what's the ideal mix between multi-tenanted and single-tenanted properties and master leases? And he knows my view on master leases because you can structure a valuation based on master leases.
Well, I'm still trying to discover which is the right balance. So I can't give you a model answer, unfortunately. But as per all industrial REIT managers, we try to maintain in a series of about 40% fixed or longer lease, or we call that single leases or master leases, whichever you call that, and probably about 60% multi-tenanted. And it also depends on the country and jurisdiction that we go to. Logistics and industrial, generally you deal with MNCs, and MNCs usually have a network of, they don't operate just in Singapore. They also have operations in different countries, and we tend to follow the tenant. And it also depends on the jurisdiction of the country that you are in. In Singapore, generally leases are in the region of 3 years. You pay one rent, you fix it, and that's it. Australia, the warehouses like to sign 10, 15 years.
And there's an escalation.
Rental escalation. In some countries like Malaysia, you have a difference of different too. So it really depends on jurisdiction that you go with. So there's no one size fits all, but generally we try to go with a 40-60, 40 fixed, 40 single tenanted or master leases, and 60% multi-tenanted, because that's what we as REIT managers are supposed to do. Supposed to manage the leases, manage the tenants, reposition the building. And if you have a $10 billion portfolio and everything is all single sale and leaseback, single tenant, then I think whoever, I would love to find that job if you have it, just give me a call, because you don't need to manage the tenants, just one tenant. So it doesn't work on that. So my view is 60-40 is good. And it allows us as the manager to make sure that we are able to be nimble, to always change the assets.
And there's some stability.
Correct. And be relevant. That's the key. Yeah.
All right. So do we have any questions from the floor, or have we no questions? Right, okay, we've got a lot of questions. Okay, but we can't cover them all because I'm told here by my bosses that we've only got 10 minutes left. We can go a little bit of time, but not too much. So the question that's had the most votes is, with the trend moving towards decoupling and deglobalization of economies and supply chains worldwide, how does it affect logistics and commercial focused S-REITs? I think you answered that.
When we are trying to take a step, on surface, decoupling and deglobalization is good for warehouses. Yeah, all right. But I don't really buy into that, because if you do that, then the pie for everyone becomes smaller, and everybody has to go to each other's pie, each other countries to go and to fight that, and you may end up not getting anything. So my frank point of view is the reason why we are facing it right now. The supply chain, while I'm a beneficiary, a tailwind of it, in the longer term, decoupling and deglobalization it's not healthy for the overall ecosystem of business, from logistics to commercial to even retail, in that sense. I think we will get out of it. China will have to open sooner or later, and Kelvin mentioned, it is true. Right now, the problem is on the supply side. You have the factory of the world being cordoned off from the whole world. Once that plug is, or that valve is slowly released, I think we will go back to decoupling. The decoupling and deglobalization would probably not be that theme of the month already. Right? And if there is some outcome from the Ukraine and Russia war situation, then energy prices will start to come down.
Yes, that's what we all want.
That's where we have. And then hopefully, as Jeff said, the hawkish stance of 2022 will be the max hawkish stance.
Yeah.
Yes.
Yeah. So that's my view for that. Yeah.
The most hawkish view on the supply chains at the moment, leading economists are saying it could be a geographical compression of supply chains. So the regional footprint becomes more important than the geographical footprint. And you see the warehouses look to support tenants that are looking to diversify their suppliers, diversify where they have their supply chain exposure, whether it's last mile logistics or it's 3PLs, the third party logistics. They're just, as I said, on the downside, there might be this it's kind of like a restructuring of the way tenants conduct their business.
Yeah. Okay, the next question, we're going to move on. So, your turn. The China property market. Well, this anonymous says the China property market is in a big mess. How does it affect REITs' performance in Asia? Well, I think our two REIT CEOs don't have any assets in China. So but of course, for both of them, Chinese demand affects his properties, and Chinese supply chain affects your properties. So we really do want that to be sorted out.
And also, I think maybe I add is that sentiments.
Yes.
Sentiments.
Bad.
Somehow or other, when people see China as the second largest economy in the world, if people start to be jittery, you're bound to be.
Yes.
You're bound to be, affected by the way you see other countries. So sentiments is to me the excuse.
Yeah.
It's also the third factor. Yeah. Even though, well, we congratulate one another that we don't have China assets.
Yes, but so we're going to jump on to Jeff, because Jeff, there are Chinese assets in some of the REITs in our. In fact, there are some REITs with only Chinese assets.
Yeah, totally. And these themes keep evolving in this new uneven world that we're in. What was interesting was, okay, China saw that deterioration in its consumer growth last year, which has seen the performance of it lag the more regional emerging economies this year. But remember, in 2020 and 2021, it held up, and it was a big part of global trade, as was manufacturing and trade growth was a big driver in REIT performance in 2020 and 2021. It was actually the industrial REITs across APAC, so not just the S-REITs. So of the 280 or so REITs listed across APAC, industrial REITs over those 2 years averaged 28% total returns. All the remaining REITs across APAC averaged 4% declines in total return. So not just the property market, but the China appetite for trade and so forth is a really big driver.
Okay, so I'm going to move on. Yes. So stay with you, Jeff. In the light of rising interest rates, which do you think are the outperformers in the S-REIT space? These two can't speak for that, because there's,
well, it depends. If the inflation is all in the US, and it means US consumers are tightening their belts, then you have some of the smaller REITs like United Hampshire REIT, which is investing in anchor shopping centers, retail shopping centers in the US. That's like the Sheng Xiong Group, if you will, of the US, because as Sheng Xiong Group has said, if Singapore consumers are tightening their belts, they may want to shop for the home brands and do more home cooking. So it really depends on how far interest rates go, how much inflation is contributing. But at the moment, the big overarching theme has been the regional reopening, not just Singapore reopening, but the regional reopening. The fact that we're opening Terminal 2 and resuming the Southeast Asian flights in about 4 weeks is super important because, as I said, the strongest real estate investment trusts so far this year have, of course, been those hospitality trusts. But also, look at the REITs as well. Remember, there's that micro side as well, the appetite for REIT managers to acquire, to divest, to recycle, to enhance. Last year, we saw half of the 40 REITs make acquisitions that had a combined property value of more than 12 billion Sing dollars. That momentum's continued somewhat this year. So we've had around a dozen REITs so far in the first 8 months of this year basically make acquisitions valued at more around 5 billion Sing dollars.
That includes GEM. I think it was half of that. Was that half of it?
Part of
Half of that 5 billion.
Actually, I sort of agree to the view, but also disagree in a way. I believe that you also have to look at the country respectively, because I always feel that real estate is very domestic play, and how you actually look at it and how you actually sort of keep yourself relevant is a key things to make your REIT performs. And I mean, for us, we have around 88% of our asset in the portfolios actually located in Singapore. And being that we do the recent acquisition of GEM, which is actually well supported by unitholder by 99.5% kind of voting for the acquisitions, we feel that I think people tends to actually look at it as the asset and look at it and how it can perform to sort of then vote in and buy into the REITs. So it has to be seeing that how the asset located and how you think being the manager of the asset, you can actually change the propositions of the asset, which actually we managed to do it by once we acquire, we do actually increase on the distribution. At the same time, I think the value of the asset, I think that is when we actually that is when we can actually sort of like make ourselves favorable for the unit holders.
Okay, so I think we'll take two more topics. One of them is a currency one. The Sing dollar has strengthened across major currencies. So how can REITs, I think we should say, how can overseas REITs with overseas assets remain relevant is probably what the question should be. And what's the impact to local investors? I'm going to start because Kelvin, you've had that Milan property for a while, and then I'm going to come to you because you're going to manage all those Australian properties. And you're going to diversify a bit more, but we can't talk about it. Yeah, so Kelvin's going to have a drink.
Okay,
tell us how he manages
sure.
the Milan.
Yeah, the Milan asset. Sorry, I don't know that.
Because at one point, the Milan asset was very important to him because he only had 2 assets. But
yeah,
he's got
actually, yeah, we started out with 2 assets. Now, fortunately, we have 3, and then the size started to double up. So the Milan asset is a very interesting one, as I mentioned to you guys, is that it's actually a CPI index packed. Is pegged to CPI index on the rental escalations, and then we actually sort of like benefit from the positive rental escalation, and at the same time, actually, it leads to a subsidiary which is under Comcast, and then is of course is a AAA kind of tenants. So in the case, it's a very safe cash flow. So because of that, we sort of like hedge our currency probably around 18 to 20 months earlier. So we do actually have a forward hedging rate, which actually probably easily around, I would think is about 1.6 compared to the current rate of around 1.4, the conversion rate. So in the case, we sort of lock in our incomes because we know that we have a good tenants, we have a good cash flow, and also it's a positive cash flow going forward. So in the case, what we do is that we do a forward hedging, so we protect that. And on the capital investment side, we do a natural hedging. That means how much we invest in the sum of euro dollar, we do equivalent of the debt. So that in the case, there's no fluctuation on the NAV. That means your book value will always be very stable. So that is what we do to actually manage the fluctuation of currencies.
So that's how you stop the NAV from coming off. Yes, Adrian, because you're going to have some, you've got some.
Yeah, I think for us in industrial, it's quite clear. It's always, yes, when you go overseas, FX will always be. And thanks to the Singapore government, and I'm thankful for that, that the Sing dollar is always strengthening. If I'm in a currency that's always falling 30% over the last 10 years, I think I'll be more worried than But for us, we see going overseas is more important than the currency risk. As Kelvin pointed out, the currency risk can be managed. And I think a lot of REITs has been successful in managing overseas assets. If you see the video down there, you'll see that I think the statistics by what Nipo told us is at least like 70% of REITs actually have assets overseas. So it means that currency risk can be managed. But for us in particular, we see the reason of going overseas more important is because Singapore industrial land leases are short. I have to go overseas to get access to longer lease, longer term underlying land leases, freehold or even leasehold. You know, Kelvin will tell me 19 years land leases is short. You try 20 years. You know? Yeah. So to us, it's more important going overseas, and that access to the freehold land longer lease length is much more important than currency risk. Our currency strategy is no different from what Kelvin has said. You need to go into countries where you can actually have the local banks lending them to you. And if you try to do a carry trade, that means borrow cheaply in Singapore, 2 to 3%, to buy an asset. There's another country that gives you 6-7%, but you'll be asking for trouble because the FX, and it has to be Sing dollars in a strengthening position. You're just asking for trouble because income will start to come down and capital will start to come down and NAV will start to come down.
Yeah, remember that. Remember, that's very important. If you want, that's why sometimes NAV, you know, when people grumble about NAV falling, that's one of the.
So yeah, but all in all, having said that, I am more appreciative to have a strong Singapore currency and a weak one. I don't know if Jeff agrees with me.
Yeah, we're not sure because the Aussie dollar's weakened somewhat, and
yeah, it's been a big part of I think investor attraction to our overall market. STI has so far outperformed all the developed economy benchmarks, and strong SGD is part of that.
Okay, so in 2 minutes, the importance of the role of the sponsor. All right. Yeah.
Well, I am of the view that sponsor is very important for REITs. But I think investors need to dive into a little bit more and ask a bit now, what is actually the business model as well as the motivation of the sponsor? If a sponsor if a sponsor has a business model where they do what we call capital recycling from birth, I mean, there's no death, right? But from birth to stabilized income, it is a full ecosystem where you can develop, you manage, you lease out, you get the asset into one of the REITs or other core funds. It means that this REIT is part of the vital core of the ecosystem to recycle capital, to make sure that we can recycle the capital in a higher yielding and look at different pockets of investors' risk profile. Some people who has better risk appetite, you should be buying the sponsor because they do developments, but they take up more risk. If you don't want, you want stable and growing distribution, you go for the REITs. So the ecosystem and the business model of the sponsor group is important. And if this ecosystem is right from a capital recycling, they have a track record to show it, then you know that this REIT is actually a vital or one of the components of this whole ecosystem. If the sponsors tries to dump assets into the REIT or try to do something that's funny, such that this vital component comes up, the whole ecosystem will collapse. So this is, and that is the business part. Now for the REIT itself, especially for us, where in particularly for us industrial, where we face two challenges. Number one, our tenants are MNCs. They don't just locate in one country. Logistics guys are all over. So that means you have to follow the tenant. Then that means that I need to go to different countries. And if I have a parent that's footprint in that country, then, I mean, Kelvin said, right, real estate is a local game. You need your local guys to know. And that is where you're able to manage it, lease it, have the customer relations, and have comparative advantage when an opportunity comes up for that. And so to me, a sponsor is also important to look at the footprint, the platform, and how does it supports the REIT, and whether the business model of the REIT makes sense when they have the ecosystem kind of business model.
Yeah. Actually, I totally agree with what Adrian has shared. I think mainly, if you look at the sponsor, you have to look at it whether the sponsor, I mean, first of all, had asset, the network, and the pipeline and the footprints that you're talking about. I know sponsor that, I mean, there are some sponsors, there's none. So in that case, that's not useful. I think what we do is that you do actually have to look at a sponsor as a way to actually, as a venue for you to do acquisitions. And usually with a sponsor tagged to it, you will have you have the right of first refusal, you will be exclusivity. So that in that case, you help you to actually grow the REIT meaningfully. I think the thing is that I think the investor have to look into it is the discipline of the managers. Rather the manager actually looking at the sponsor pipelines, consider it clearly whether it actually helped the REIT to grow. Is it positive to the unit holder? I think that is the most important thing. So the sponsor, having a sponsor or not having a sponsor is not the key question. I think the key question is that whether the manager set a discipline to make sure that he actually look through all the asset that is available, be it the sponsor assets, be it the external asset, whether it helps you to grow or whether it helps you to sustain on your DPU. I think that's more important. And I think that's why I think it is.
Having said that, he's got a very famous sponsor. Jeff, I think in that clip by Vitas, I think Ronald talked about getting more sponsors, good sponsors, because we've had sponsors, I mean, we've had troubles with our REITs, we won't mention it. So do we have good names coming in? Big names
and we had good names from
recognize?
the outset, from the likes of Keppel and Mapletree and Capital Land and which really played a really big part in getting this REIT market to start. We had a fantastic first 5 years from 2002 through to 2006. And 2006 really was that watershed year that enabled us to really start branding ourselves as a regional hub from 2007 onwards, as Jonathan mentioned in that video. But for the sponsors and for the investor, I think the question is really, like, from an investor perspective, managing your portfolio, you decide, do you want concentration risk or income stability? And that's all up to the individual investor in terms of how comfortable they are with that. And then obviously they can look at the REITs and see how the REITs operate from there.
So on that, I've been told we're really out of time because we've gone way over time, and I'm very sorry for keeping you for so long. But thank you very much. And
thank you.
Thank you.
Thank you, Gola.
Adrian. Thank you, Kelvin. Thank you so much.
Thank you very much. Thank you.
Thanks.
Hey, thank you so much, Gola, and the panelists. Thank you, Adrian, Kelvin, and Jeff. So before we end, we would like to thank Tiger Brokers, who is our exclusive event broker. And they have a booth outside. Please head to the booth and talk to them. And they have some goodie bags for you guys. And yes, also some refreshments outside. But before you head out, we'd appreciate if you could do a short survey for us regarding this event. And also, we do have another session next week on Monday, also same time, at the same place. So do sign up for our next session on 26 September to secure your seats, okay? And we are also right now having a $20 off subscription from 19 September to 30th September for the Edge Singapore subscription. So you can scan the first QR code for that. Yep. So thank you for coming, everyone.
Wow, must link kopi already one day. Are you guys into cycling?
No, very tired.